Smart individuals often overestimate their ability to predict financial outcomes, leading to risky decisions. Studies show that 80% of day traders lose money within 5 years, yet many persist due to the illusion of control. This cognitive bias makes us believe we can time markets or pick winners, despite overwhelming evidence that even professionals struggle. The 2020 GameStop frenzy exemplified this, where retail investors ignored fundamentals. Behavioral finance reveals this as a mix of overconfidence and pattern seeking in random data. Neuroscience proves financial decisions are 90% emotional. When Bitcoin hit 2021, dopamine-driven buying surged 300% on Coinbase, only to crash 50% weeks later. The amygdala, our fear center, similarly triggers panic selling during corrections. MIT research shows investors who removed emotion by automating trades earned 4% more annually. Real-world example. 73% of millennials sold stocks in March 2020's COVID crash, missing the 68% rebound by July. Harvard studies reveal investors hold losing stocks 50% longer than winners due to sunk cost fallacy. We irrationally cling to bad investments to avoid admitting mistakes. Case study. Lehman Brothers employees kept 30% of their 401k in company stock until bankruptcy. This bias costs the average investor 1.5% annually. Behavioral economists suggest presetting stop-loss limits to override emotional attachment to past decisions. Princeton researchers found herd mentality causes 85% of individual investors to underperform indices. The 2021 meme stock phenomenon saw AMC's price surge 1,200% despite 90% of traders not reading its financials. Social media amplifies this. Analysis shows stocks mentioned on Reddit's Wall Street Bets had 230% higher volatility. Contrarian investors like Warren Buffett profit by avoiding crowds. Be fearful when others are greedy. Nobel laureate Richard Thaler proved our brain discounts future rewards by 40% annually. This explains why 68% of Americans can't cover $1,000 emergencies, despite median incomes. Vanguard data shows $10 invested in 1980 would be $750 today if untouched, but the average investor's trades reduced gains to $290. Visualizing compounding, like Amazon stock growing 200,000% since 1997, helps resist impulsive spending. A Federal Reserve study found 40% of the wealthiest 1% inherited assets, yet 78% attribute success solely to skill. Survivorship bias distorts perceptions. For every Bezos, 100 failed e-commerce startups existed. Even Buffett admits being born in 1930s America, access to stocks was crucial. Researchers suggest writing luck journals to counter overconfidence. Key insight: prepare for risks you can't predict, pandemics, AI disruption. UC Berkeley research shows 70% of high earners live paycheck to paycheck due to lifestyle inflation. Each 10% raise leads to 8% spending increases. Cars, homes. Real example, NBA players averaging $5 million salaries go bankrupt at 60% rates within 5 years of retiring. The antidote? Automating savings first. Those who save 20% before spending build wealth regardless of income level. Black Swan author Nassim Taleb proved rare events cause most market crashes, yet 90% of investors underestimate them. In 2008, AAA mortgage bonds collapsed, a 0.1% probability per models. Modern risks like climate change, projected to cost $23 by 2050, are similarly ignored. Practical defense: keep 2+ years' expenses in cash, diversify globally, and avoid leverage that amplifies disasters. Dalbar's 2023 analysis shows passive index funds beat 92% of active managers over 15 years. Complexity, like day trading or derivatives, often hides fees and behavioral mistakes. Example: the S&P 500 returned 10.5% annually since 1926, while the average investor earned just 4.3%. Fintech apps now automate simplicity. Acorn's Roundup Investing grew 300% faster than traditional brokerages by removing decision fatigue. Princeton researchers define true wealth as control over time, finding happiness plateaus at $75 per year. Case studies show retirees with $500K and no debt report higher life satisfaction than stressed millionaires. Morgan Housel's formula: wealth equals savings plus optionality. Final tip: automate finances to spend mental energy on relationships and growth, the ultimate ROI.